The price of cryptocurrencies like Bitcoin can fluctuate daily or even hourly. Volatility, like any type of investment, can lead to uncertainty, FOMO, fear of missing out, or even dread of participation altogether. How do you determine when to buy while prices are fluctuating? It's straightforward in an ideal world. Buy low, sell high. Even for specialists, this is actually easier said than done. Dollar cost averaging, sometimes known as DCA, is a method employed by many investors to lessen the effects of market volatility by routinely investing a lesser sum into an asset, such as stocks, gold, or cryptocurrencies, as opposed to trying to time the market. When someone believes their investments will improve in value over the long run and encounter price volatility along the way, DCA may be the best option. Describe DCA. Using the DCA method, an investor routinely purchases smaller amounts of an asset over time, regardless of price, for instance, investing $100 in Bitcoin each month for a year as opposed to $1,200 all at once. Depending on their aims, their DCA schedule may evolve throughout time and persist for a short while or a long period. Although DCA is a well-liked method of purchasing Bitcoin, this method of coping with stock market volatility has been employed by traditional investors for decades. If you regularly invest through your employer's retirement plan, you might possibly be using DCA already. What advantages does DCA offer? Without the famously tough task of timing the market or the danger of unintentionally squandering all of your money to invest a lump sum at a top, DCA can be a useful approach to own cryptocurrency. No matter how expensive an item is, the goal is to routinely invest a manageable amount. This may average out the price of purchases over time and lessen the overall effect of a sharp decrease in costs on any particular purchase. And even if prices do drop, DCA investors can still buy as planned with the chance to profit when they rise. When is DCA more beneficial than investing a lump sum? An investor can enter a market safely with the aid of DCA, begin to profit from long-term price growth, and balance off the danger of short-term price declines. And in circumstances like the ones listed below, it might provide more predictable profits compared to making a large investment all at once. Purchasing a product whose value might rise in the future. An investor can utilize DCA to invest money during the time period they believe a downward movement will occur if they believe prices are poised to decline but are likely to recover in the long run. If they're right, they'll gain from being able to purchase assets for less money. However, even if they are mistaken, they will still have market investments as the price rises. Betting with volatility as a hedge. Investors are exposed to prices over time through DCA. This technique seeks to balance out any sharp increases or declines in portfolio value during periods of price volatility while also profiting modestly from price movement in all directions. Avoiding emotional trading and FOMO. DCA is a method of investing that is based on rules. Beginner traders sometimes fall prey to the emotional trading trap, in which decisions about whether to purchase and sell are influenced by emotions like fear or enthusiasm. These can influence how well investors manage their portfolios, consider panic selling during a downturn or overbetting out of concern for missing out on exponential growth. How does DCA function in real life? Any DCA strategy's success is, of course, still dependent on market conditions. Let's examine a real-world price example to illustrate this as Bitcoin was about to see its greatest decline to date. Starting on December 18, 2017, around the price peak of that year, you might have invested $100 in Bitcoin each week for a total of $16,300. However, your portfolio would be worth almost $65,000 on January 25, 2021, representing a return on investment of more than 299%. Going all in, while prices are peaking, however, is typically regarded as a bad idea, but how could you know? On December 18, 2017, if you had invested the same $16,300 in its whole, you would have lost approximately $8,000 in the first 2 years. Although your portfolio would rebound, you would have missed the opportunity to compound your gains at that time, and perhaps even been so alarmed that you sold your Bitcoin for a loss. Say you waited a year and made a $200 monthly Bitcoin investment from December 2018 to December 2020. In this scenario, as opposed to $23,000 from lump sum investing, your portfolio would have a total value of slightly over $13,000 in 2020. You would have made more money from an all-in investment, but it would have been riskier because any large price changes after the date of your initial investment would have had an impact on the entire investment. Hedging your bets is the main goal of dollar cost averaging. It limits your upside potential in an effort to reduce prospective losses. It attempts to lessen your risks of suffering major losses to your portfolio due to short-term market volatility, making it a potentially safer option for investors. It's crucial to consider your particular investment conditions in order to determine whether DCA is the best plan for you. It is always advisable to seek advice from a financial expert before beginning a new investment strategy.